Well, greetings everyone, and welcome to one of our special edition investing topics with Mark and Ken. And every once in a while, one of our friends will straggle in to help us out. We'll take all the help we can get. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, one of the co-sponsors of these educational sessions. I'm joined here by my good friend Ken Kavula from the central Michigan, mid-Michigan area, I should say. Say good evening, Ken.
Good evening, everybody. How are you all?
Well, I'm enjoying the erratic weather. I hope everybody's having a good time. We finally disobeyed the governor and got some garden stuff, and we're getting ready to put that stuff out, but the weather's pretty erratic. And speaking of erratic, Ken, do you recognize that middle picture on the opening credits?
I certainly do. That's Bill Murray, isn't it?
It is. And
I'm going to guess it's from Groundhog Day.
So Punxsutawney has made its first appearance. One of our sessions right there.
Yep. We do have a hand in the air, Mark, and I'm going to recognize our friend from New England, Ernie Felzani.
Go for it, Ernie.
Hey, Ernie,
Hi.
you're unmuted. Hi, how are you doing?
I'm very well, and we've had some cool weather, and you guys do a great job. I just want to say thanks for bringing these programs together to all of us. That's all.
You're welcome, Ernie. Thank you.
Yep, we enjoy doing them, Ernie, so as long as we enjoy them and you enjoy them, we'll keep on plugging at them.
All right, and
keep
that
going, Mark, you're up. Yep.
Picture on the right is just simply a tribute to all the homeschool teachers that are out there right now. Our dear friend Kurt and his wife Tina have two young grade school sons that are, and now they're not using this approach to teaching that's being shown on the screen, but I'll bet there are times when they're tempted. And I do know a few people that just accomplishing amazing things with their kids at home and still holding down a full-time job. So we'll raise a glass in your general direction also. The Facebook quote in the middle of the screen is something that I post just as a tribute to the quarantine and the reality that I was due for a haircut when this thing hit. So things are getting pretty interesting. And as the Facebook mention says there, my wife has begun to confuse me with Fabio. So you can take that for what it's worth.
Not very much, Mark.
All right, here's our traditional cover slide. We're here to talk about the Quarantino Mayo, the virus, a little bit of groundhog action. Be careful out there. And in keeping with the spirit of the moment, I found a nice mask for Ken that's fully compliant. And even the Knight has a very high-tech mask. And in case you doubted me about my Fabio, I'm there on the right. I know, nobody can believe it. All right, let's get the legal stuff out of the way. No investment recommendation is intended. This is all about education. It's a demonstration of the analysis methods and techniques, the methodologies pursued by the modern investment club movement as interpreted by Manifest Investing and Better Investing. The views that we share here are our own. Do your own homework, please. And if we do talk about a company that we actually own, we'll try to disclose that. If you'd like to add a friend or a family member to our reminder list, email nkavula1@comcast.net. And if you'd like copies of the slides like we were talking with Debbie in the green room, or if you have a follow-up question, Mark R. at manifestinvesting.com. All right, Ken, would you like to kind of drift us through where we'd like to go tonight?
Well, sure. We're going to talk a little bit about this Manic Market. We're going to show you the damage that's been done and the damage that we think might be done going into the future as far as the market's concerned. And specifically, we're going to point at some specific studies and show the impact that this kind of drifting idea among our analyst community seems to be having on some of the smaller companies that we study. We'll take time out for a moment just to glance at the Groundhog Contest. Many of you are Groundhog Contest participants, and I don't know if you've noticed, but under the dashboard tab, The Groundhog 2020 results have started to be posted, so you can rush there and find out how you're doing. And then we're going to talk about some stocks that we think might be doing fairly well. What could possibly go wrong? That's the phrase of the hour right now. Talk a little bit about some protection, and then we hope to have some time, maybe 15, 20 minutes for Q&A. We used to promise that we'd answer all the questions at the end of a session when we had smaller audiences, but as our audiences grow, the number of questions grows, and we're not going to stay here tonight until 10:15 or 10:30. So we'll answer a few of the more pressing questions. And if you still feel you need a question answered, don't be afraid to email either one of us. We're used to answering questions, and we try to get them answered in a real timely fashion after you send them to us. So without further ado, let's move to the next slide, Mark.
Yeah. Plus, if I'm in full Fabio mode with my second margarita, the quality of those answers at the end of the night might be kind of touchy. All right, here's our quick reminder of what's gone on over the last 20 years. You're looking at the S&P 500, and the only purpose of this slide is to illustrate how large the price swing has been here over the last 3 months. And you can see on the right, that's definitely quite a murmur in the old EKG over the long term. And again, compare it back to what was at the time one of the worst moments in stock market history 10 years ago. Almost everybody here remembers that well. Anything grab you about this, Ken?
Well, yeah, Mark, I've been looking at graphs and slides very similar to this one for the last 3 or 4 weeks. And the first thing that I find really interesting is that the relative value this time, at this point at least, has not sunk below 30 as it did for the market back in 2008, 2009. You and I have talked a number of times about the real differences in this downturn versus a lot of the downturns we've lived through. We've always had kind of a running start at the downturn, or it might have been some kind of carnage early on and then just grinding lower and lower and lower. That's the way I kind of felt in 2008, 2009. But this downturn was just a stop, a cessation in almost all business activity except for necessary circumstances. Even places that were kept in business are doing pretty poorly right now. I'm thinking specifically of our hospital systems that have devoted all of their resources and almost all of their time to the COVID-19 virus and have postponed the kind of surgeries that really keep the hospitals in the black. All the elective surgeries have postponed. Now, eventually, of course, they'll need to be done, and that'll be some profit for hospitals. But right now, they're going through some times that are just as rough as the schools and universities and restaurants and you name the industry, and it's having some real troubles. Again, we know that when that relative value, that relative strength index, that's being graphed at the top up there, falls below 30, we know that that's a signal for it might be time to really start to buy. And we haven't reached that point in this particular downturn at this particular time.
No,
we've also
there's no saying that we will have to do it either.
Yeah, absolutely. We're not saying to our audience that it's going to go there. We're not very good at predicting. If you remember 3 years ago, we predicted there would be another recession and it would start on a Tuesday. I don't know, did this one start on Tuesday, Mark? If so, we're geniuses.
Absolutely, absolutely.
And if it didn't, we were really close to calling it. So.
Yeah, within 6 or 7 days.
Okay. I have a hand up again, and it's Ernie again, so I'm going to unmute him and see if he has a question, okay?
Sure.
Go on, Ernie.
No, I'm all set. Sorry. I'll take it down.
Okay.
All right, same type of information, just illustrating, again, this is the value line arithmetic index, so it's 1,700 companies, not 500. And again, that shock of 10 years ago versus what we saw here, the chasm, as we've defined it, we did a presentation on it a few months ago. The chasm is starting to take shape. I mean, there's still a pretty good space between the green price bars and the long-term blue trend line. And that snapback, almost like a rubber band snapback of the collective return forecasts that is shown right here. It's basically a combination of prices going up. We've had a 20% gain in basically a little bit over a month, in combination with a reduction in expectations for the companies. Just as a case in point, this is kind of a sidebar, but just as a case in point, I just updated the issue 13 banks in the Value Line Investment Survey, and I can say virtually across the board, every company's long-term return on equity was reduced by 10 percentage points. In other words, a company that was expected to come in around 10% for its return on equity was dropped to 9. If it was 15, it was dropped to 13.5. And that was pretty much across the board. And you'll see some fairly staggering reductions in the financial services companies, mostly the banks and insurance companies. So be prepared for that. Here's the slide we said we wished we'd have had a month ago. So we've got it this time. What you're looking at is basically a stock selection guide, but done on it's a little over 1,300. It's about 1,320 companies that are industrials. In other words, not asset-based financial services companies. And you're looking at the sum of all of them. So my nutshell description for all of you is, I really don't care so much about GDP. I really care about what this looks like and what the red line looks like. And what reaches out and grabs you here, Ken?
Well, what reaches out and grabs me, and remember that Manifest always kind of folds in the expectations for the next 2 fiscal years. So when you're looking at that last dot, you're looking at 2022 and 2021 before it. The current year is 2020, obviously, and there's that decline that we're expecting in 2020. To me, it doesn't look much worse than what was going on maybe in 2016, and it definitely is looking better than what was going on in 2008, 2009. Value Line, at least, and Value Line's a pretty well-respected journal of analyst opinion. Value Line is right now, at least, kind of thinking that by 2021, 2022, we're going to be back on trend again. Now, that's not as high a growth as we might have seen from 2016 to 2018. I mean, that's a much steeper slope on that line right there. And it's definitely not as high a slope as we saw from 2009 to 2011, but it is the kind of growth we saw from 2011 to maybe 13 or 14. And it's pretty decent growth because it's matching the trend, and that trend has been pretty vigorous over the last 15, 20 years. I see that the earnings are kind of mimicking that same general idea. So I'm cautiously optimistic that while I don't expect us to pop out of this recession in the next quarter, or maybe even by the end of the fourth quarter of this year, I do expect that Value Line has more right than wrong, and we will be moving back to trend by the time we're into 2021, 2022. That's not such a long time to wait as I might have expected.
Yeah, and basically what we're doing is foreshadowing a little bit of thunder later on in the program and encouraging everybody here as an investor. So we really shouldn't be thinking about quarter to quarter, or perhaps even the next year or two. We, with a long-term time horizon of 3 to 5 years, with emphasis on the 5 years, if we really do return to that trend line, you can't do anything but treat the investing world of opportunity as a good thing. At the same time, things are not dramatically undervalued at this point. Kind of in the middle of the pack. And I guess we'll close this slide with just a reinforcement of what happens during a recession. Basically, our stock selection guides get wrecked when some of the companies go to zero on earnings. And that's kind of what we saw back in 2008 when the average profitability dove way down here. And again, the average company was at a historical low, and we are approaching that now. We've actually watched that kind of wind down recently. And again, just to make the point, what that recession means is your stock selection guides are going to get messed up. And the fact that we've arrived at this point says the same thing again.
I really like that sentence that you had, Mark, that stocks might be closer to fair value than we anticipate. You know, for a while, right around the middle of March, when that crash occurred, I was finding lists of buyable stocks that I was excited about putting money into, and that at the same time I was fearful of putting money into. That, by the way, is a good indicator, according to Warren Buffett. But I don't find that list nearly as long as it was a month and a half ago.
Oh, it's not.
I think that I know it's not, and I think that I'm finding more instances of stocks that are fairly valued, or maybe in some cases, if I'm looking at really high quality stocks, maybe a little bit overvalued, in fact. Exactly. So I'm being much more careful when I'm allocating resources right now, and I'm really working on keeping my judgments on the conservative side, and trying to keep a little bit of powder dry in case a large portion of the analyst community is correct, and we have to go back down and test some much lower values before we start really recovering.
Yeah, I share the same feeling. 4 to 6 weeks ago, I was having trouble studying fast enough and putting cash in places fast enough. And I tell the story. I was on the phone with Kim Butcher talking about a stock. It was at $24. I went up for lunch and made myself a hot dog and came back downstairs and it was at $34. I am not making this up. So I'm like, well, I guess we got to move on and study something else. That's the type of ferocity that we've seen from time to time. I did buy some shares of Wolverine Worldwide about a month ago. That's up 100%. So those values are gone for now. As Ken was saying, though, they could be back. All right, one last slide just to make a point.
The big thing, Mark, that I saw also that was different from 2008-9 was that I felt I had a good period of 5, 6, 7, 8 months where I had a lot of stocks to choose from, and I think that this time around I was lucky to have a period of literally 2.5, 3 weeks before a lot of the bargains disappeared as far as my analysis was concerned.
No, I remember it well. We were buying from November 2008 all the way up hard into March 2009, and being kind of stubborn about it. And that same type of buying period lasted a few days this time. All right, so how turbulent is it with respect to the analysts? And this is restricted to just Value Line. The other stuff is a combination of analyst consensus, but this is just Value Line. And I would have trouble imagining that this could happen. Most of the fault here, the blame, is on the erratic situation with the oil patch. And what you're looking at is basically the standard deviation of all the forecasts in Value Line, and they have gone crazy. I mean, companies have gone to 8 to 10% forecasts, up to 50, 60, 120, and that's what's blowing up that right bar on the right-hand side. I would not have dreamt this is possible. So this is happening at the same time that the analyst consensus is a little bit friskier. You're seeing drop coverage on companies. You know, that's a highly technical term, Ken. Stop laughing.
I think you're being very kind to the analyst community also when you're using the term frisky, Mark.
Okay. Well, anyhow, they are animated, and maybe they're not used to working from home. Maybe that's part of the problem. Maybe. No, I was going to speculate that they might be consuming adult beverages while they build their forecast, but we don't need to do that. Anyhow,
Well, but we've
it's messed up.
always, Mark, we've always characterized the analyst community as herds.
Oh,
You know, whether it's a crash of rhinos or a herd of something else, and I think they thrive on each other's opinions, and I think right now they've been stripped of the opinions of their peers, and so they're on their own. They're not getting guidance from a lot of the companies they study, and I think what we're looking right here is the analyst community setting their hair on fire and deciding on huge ranges between one analyst's call of sales growth and their buddy's call from two brokerage houses down the street. You know, it used to be when I looked at the range of sales calls when I was studying a stock, I was lucky to find them varying by more than 2 or 3 or 4%. Now you can look at a stock sometimes and see it vary by as much as 15 or 20 percentage points. It used to be an anomaly when I was studying a Chinese stock called NetEase. I drew it to Mark's attention that the manifest tables, which were based on analyst opinion, were so far away from the SSGs that my club was doing, and what might be the reason? Well, it turned out the reason that the analyst's opinion, while of course having an average because it was a set of numbers, the average was based on a set of numbers that was so widely dispersed that the average practically lost all of its meaning. I mean, when you go to numbers between 2 and 35 and then try to deal with the average as representing that sample, you really have some issues. And I think that's what's going on partly with this huge value in forecast variability at this point.
yeah, it's certainly part of it. So I do predict that, well, one of the things that they do is they find the family dog when they're working from home and hand some of that homework to the dog. He eats the homework, and they cease coverage on a bunch of these companies. So the ones that are way out of whack, they just simply disappear from the database. So the red bar goes down.
Mark, we are getting some questions on how exactly that variability is calculated. That was the same question I had for you this afternoon when we looked at this slide. How is that calculated, Mark?
It's just basically the standard deviation. So you're looking at a variance characteristic of the entire database for Value Line, the 1,700 companies. So it's just graphing the standard deviation over time.
And Mark, is this graph graphing sales or earnings or return? What's it graphing?
It's the return forecast.
Okay, that's answering a whole slew of questions as well then. All right.
Yep. All right, so let's press on. We did have a question that came in that we thought was fairly interesting because it really struck some nerves. I don't know if Joan is with us. Did you get a chance to check the attendees?
I didn't, Mark.
Joan from
I will.
St. Louis.
I didn't. Joan, if you're around, why don't you either raise your hand or drop us a something in the question box, okay? And meanwhile, I'll look and see if we have any Jones at all.
Her last name is Clark.
Okay.
All right.
Why don't you keep going, Mark? Yeah.
We'll keep going. Again, here's the situation. Again, tying that last slide in, do we see anything really messing up, especially some of the smaller companies and the quality ratings? And Joan actually shared a couple of companies that she was concerned about. Lemaitre Vascular, that's one of our, it isn't among our best small companies, but it's one that we have watched very closely. I'm pretty sure we picked it for a roundtable a little while back, but the quality rating tanked earlier in the year, and she's just wondering what's up with that. And then Hexcel was actually selected at the last roundtable, and it also had a fairly vicious and unkind drop. Both are B+, which is, again, average, as she points out. But it just makes her wonder if aren't some of these smaller companies are not getting hammered on the quality side of things. I want to use it as an opportunity to underscore that small cap is not necessarily small company. It's simply a measure of the value of a company, the capitalization. When we say small company, we're talking about faster growing companies. But
Mark, Joan is with us tonight. I'm going to unmute her and just see if we've
excellent.
caught the gist of her question. Joan, you must be muted on your side, Joan. Oh, no, there you go. It's on. What? No, it's not. Joan, you're muted on your side, so you'll have. There we go. Why don't you say hello, Joan?
Hello.
Hi, Joan.
Hi, how are you? Have we captured your question pretty well, Joan?
Yes, I think it's a direct quote.
Okay.
Okay.
Anything
then,
else you're curious about?
Now I'm anxious to hear what you have to say.
All right. Well, let's go ahead and launch into it then.
Give it an answer. Yeah.
And notice,
Okay.
Joan, I did include a cardinal on this page just for us. All right. So, all right, a little bit of a timeout here. You're looking at a picture of a stormy St. Louis. This is actually from one of the last trips that Ken and I made down there a few years ago. I snapped a picture much like this one, but this one was captured by a professional photographer at the same time. And I just think it's kind of a cool picture. And it's our excuse to talk about one of our favorite subjects right now. Ken, why don't you go ahead and describe the opportunity?
Well, we're sitting at home, folks, and we have time on our hand. We also feel real lucky to have great friends like those that are pictured on this slide. So about 10 days ago, we decided that we were going to run a conference, and we were going to call it the COVID Cancellation Conference, subtitled Investing Before, During, and After a Storm. So we got on the phone, contacted Kim Butcher, Pat Donnelly, Cy Lynch, and Hugh McManus, and said, guys, you want to help us out by putting on a conference? And after the initial shock that we were going to try to do something like that in about 20 days, they all agreed to participate. So sometime tomorrow or early Thursday, all of you that are getting our normal reminder list about the roundtable and about this program that we're on tonight, you're going to be receiving an email from my wife from the Mid-Michigan chapter, and it's going to give you the opportunity to enroll in any one of 5 classes, or all 5 if you want, that we're putting together under the umbrella COVID Cancellation Conference. We're going to kick off next Thursday, that's the 14th of May, with an evening session of Let's Talk Stock. And we're going to all give you our best stock ideas, 2 or 3 apiece. It should be a pretty rousing session with some pretty good ideas coming forth. On Friday the 15th, we'll have one class at 2 p.m. and one class at 4 p.m. Eastern Time. And then on Saturday the 16th, we'll have a third class at 1 p.m. and a fourth class at 3 p.m. Again, you're going to be able to sign up for as many as all 5 classes if you wish, or just 1 or 2 of them if that's what fits your schedule. We're going to be sending you this email, and there'll be 5 different links in it. If you want to sign up for the 5 classes, you'll have to go to all 5 of those links and do the terrible job of signing your name and your email address 5 different times. Again, next Thursday, Friday, and Saturday, and the email you're going to get tomorrow is full of the details. I'm sure I've missed 2 or 3 of them, but once you read that email, if you have questions, you can contact me or Mark, and we'll be sure to get you pretty good answers.
Okay. And now on to our regularly scheduled programming. All right, here's a look at what Joan is describing with Lemaitre Vascular. And yeah, it had been crunching along pretty well. The blue quality EKG, you can see, had plateaued off and was crunching along pretty good. And then come the early part of this year, the quality sagged. And again, just for people who may be joining us for the first time, we basically calculate an unemotional quality rating for every company and then rank those ratings. kind of like, curving the scores on a test or whatever. They're ranked in a percentile ranking. And the four primary components of that quality rating are right there. Again, it's kind of intuitive. You want a company with a strong balance sheet, good, solid financial strength. We love up, straight, and parallel. So earning stability is a good part of it. And then we're always mindful of the growth and profitability characteristic of companies versus their peers and competitors. So basically those four main components, now there's some subcomponents and other stuff going on, but that's what makes those quality rankings and what is depicted there in the blue line. So anytime a blue line, like it's shown here for Lemaitre, starts chunking down like that, you know that something is wrong in one of these categories. Either the financial strength rating has been adjusted or they're slowing down relative to their competitors. Something is at work here. Something is amiss. So what we've prepared for you here tonight, I'll do Lemaitre and Ken can talk a little bit about Hexcel. Basically what you're looking at here is towards the end of last year, kind of an interesting company. We have featured it. We've talked about it a little bit. Decent looking top line characteristics, running around at double-digit sales growth, profitability in the upper teens, fairly consistent PE ratio for a company at this point in its life cycle. Everything is looking pretty good. This is, again, the makings of an emerging quality company back at this time frame. So we fast forward to what has actually happened, and this is at the heart of Joan's question. You notice on the right-hand side of the graphic here, well, the top line kind of hit a speed bump. We'll call that a speed bump for now. Earnings followed suit. So we have some real erratic turbulence going on here. You can see that the profitability of the company actually plateaued off. It's still in a nice place, but it's not doing what it was doing. And so we're looking at a situation where, again, think back to those components of quality. We've seen a drop in the sales growth forecast from 11 to 7, a drop in the profitability and measured by the net margin forecast from 17 to 14. The PE hung in there all right, but I think you're getting a feel for, obviously it went from this type of company to this, and that basically accounts for the deterioration or the sag in the company quality. Now, it's not an emergency situation, but if I'm studying this company, I would really want to be watching closely to see, how are they going to, what happened, what can we actually attribute a cause and understand it? Then what is the company doing about it? How are they going to get back on those trends? It's not unusual for a company to have this type of a moment in its life cycle. And again, if they're addressing it well and they have a nice field of opportunity in front of them, could even ultimately be an investable opportunity. Any questions or comments on that, Ken?
Yeah, Mark, we have a couple hands. We have a couple hands in the air. So let me unmute Steve. Steve, it's either Kunze or Kunz.
Kunz, I think.
Kunz, and Steve, you're muted on your end. So in order to talk, you're going to have to unmute yourself. Okay, Steve, you have to unmute if you want to speak. Okay, I'm going to move to, there we go. Steve, you're unmuted. So what's your question? Okay, we're having some sound problems with Steve, so I'm going to mute him back up again. And we have a question from Deborah, Deborah Dittman. Deborah, again, you're self-muted, so you have to unmute yourself. Okay, let's just continue then, Mark, and let's move on to Hexcel then, okay?
Okay. So take it away, Ken.
All right, well, I did a Hexcel study at the roundtable just a week ago. And if you remember, that was before May 1st. I didn't have the latest data point coming in. The latest value line had just been published, and I was made aware of it that day, and I used some of the data in that value line, but I should have read the value line a little bit more closely. You can see that this was a relatively slow-growing company with pretty decent margins, however, and the earnings were growing pretty well. This company makes composite materials for use in the aircraft industry. Carbon fiber is their biggest product. So I was quite surprised when the next day I started getting emails asking me why the quality rating for Hexcel had dropped so drastically from what I had presented. Here's a picture of what's going on. If you kind of back up to the high point on the red chart, that's the data point that came from the very end of March. And now if you look at the next data point, that's the data point that came from the end of April. You can see a huge plunge in par value, in potential annualized return value, but more importantly, if you stick with the same verticals there, you'll see a huge plunge in the quality rating. So between my presentation, when the quality was really pretty decent, up above 80, and when the par was at an all-time 4-year high, the stock had plunged to a quality rating down around, oh, I don't know, 55 or 60, and a par value down around 10. So a really, really huge change just based on the analyst opinion coming from a series of updates that were done after the presentation. Let's go back to that chart that Mark was showing. And no, where you were, Mark, that's good. Next slide. Yeah, right there. And we'll see what was happening with the numbers. The sales growth was trimmed more than in half, from 5.4% to 2.5%. The margins were trimmed, not as drastically as you saw the margins trimmed in Lemaitre Vascular, but still the margins were trimmed. And you saw values that will move really greatly the quality rating itself. So there's the picture. There's the extension into the next 2 fiscal years, 2020 and 2021 for this company. And you can begin to see that there's quite a bit of deterioration going on in sales, and that while the earnings are moving upward again, they're not going back to where trend was. So when you see the analysts become as schizoid, that's the word I use instead of frisky, when you see them becoming as schizoid as they've been in the most recent 6 or 8 weeks, then I think you're also going to find these huge swings, especially with the small, medium-sized companies and the small companies, because even in the best of times, these companies are not covered by huge numbers of analysts. They're covered fairly thinly. And even in the best of time, Mark and I have discovered that Value Line tends to have a little bit of an issue dealing with smaller companies and dealing with abrupt changes in their business model. Value Line, like many of the analysts that I watch, seems to overcompensate in both directions. They tend to become a little bit too aggressive when things are going well, and then they swing that pendulum as far as they can back the other way, and in my mind at least become so conservative that I wonder what they've been doing with their free time. So all in all, I think you can anticipate these companies having some issues going forward. I like Hexcel a little bit better than Lemaitre, although I own Lemaitre Vascular. I like Hexcel a little bit better in this case because I find at least the long-term projections out to 2024 for both margin and for PE ratio tend to be moving back up towards trend. And I think that's healthy for a good, solid growth company. I also think that the very nature of both of the industries that these companies are in augur for much better times and maybe not in the far distant future. Lemaitre Vascular makes a lot of equipment for vascular surgery that's been put on hold in the hospital systems throughout the country. And Hexcel, as I told you, makes material for the aircraft industry. And again, that's practically drawn to a complete halt at the moment, as there's not many planes being built or repaired during this particular time. I'm worried a little bit about these two companies, but I'm not giving up in following them. I have not sold, and I don't intend to sell my Lemaitre. I have postponed my purchase of Hexcel, however, and I will wait for what I feel is an opportune moment when I get high quality and I also get some par that's fairly decent.
Yeah, and the reality is, by the time of the round table, most of the price damage had been done to Hexcel. One of the reasons it was attractive in the first place. So, I mean, I think our cost basis is around 30. So it's just a matter of it's not exactly the same type of company that we were looking at just a week before that. Interesting
Okay,
stuff.
Mark, we are getting a question. What would we say suddenly happens to a company to make it go up in quality? The thing that comes to my mind immediately is a change in its financial strength, up a notch or up 2 notches. What else could make it go up, Mark? Just the exact opposite, I guess, of what we've been talking about, right?
Any of the factors that we've talked about, any ratcheting up of profitability over the long term is a really big factor. A company improving its capital structure, something that we don't talk about a lot, but you know, in the case of this company, all of this stuff down here matters, folks. You know, whether the company's got way too much debt, whether it's at a very high interest rate, as you can see here, that's a little bit above average. So it's a little bit junky when it comes to the interest rate that they're paying on their debt. So that can also be an indication. So if they were to pay off some debt, they actually did in the last month or the last quarter, paid off a little bit of debt, but improving that capital structure, getting a better rating, those are the type of things that are going to make that type of a difference.
Mark Herman must be new with us. He wants to know what PAR is. Can you give him a real brief definition of PAR?
PAR is the long-term return forecast. It's known as the projected annual return. So the projected annual return, it's one of our key indicators for making decisions about buying and selling stocks. That's what you see here. So we're looking at Hexcel, looking at a 5-year time horizon and expect a 23% annualized return from where it's at now. And again, Herman, that would be based on the assumptions that you see there: 2.5% sales growth, 13.5% margin, and a PE of 19. Basically generates that forecast.
I'm going to take 2 questions here, Mark. One from Cheryl, and she wants to know, will she be able to pass the 5 links for the COVID conference along to anybody else that she wants to invite? And the answer is absolutely yes. You can pass those links to as many people as you'd like to invite to the conference. It's free for members and non-members, and those links will work as many times as you duplicate them and send them out to other people. So feel free to pass them to as many folks as you'd like. Petra wants to know, how could you find 2 value lines to compare the value line that came before the May 1st value line to the May 1st value line? And Petra, if you're subscribed or if you're using value line from the library, you will notice that not only do you have access to the most recent value line sheet, but you have access to the 4 sheets that go before that sheet. So it's just a matter of printing the sheet before the most current one and then actually sitting down and comparing it to the most current one to find out some of the changes that have gone on. Mark, that's keeping our question box kind of clear, so
Yeah.
I'll let you move on here.
I do want to do a clarification, and I'm kind of defending you here, Ken. All the stuff that's happening here is in between the next to last sheet and the current sheet for Excel. In other words, within the last quarter that you can see here. And just as a reminder, the forecasts for 20, 21, and 22 are not value line. It's actually the analyst consensus delivered by Y charts. But I will tell you that those numbers changed as much as you saw on these screens in the last week. I mean, it's just like somebody slashed them, and they slashed the tires, and the tires are letting out air. That's literally what you could watch happening every day if you're watching this company and watching those forward-looking analyst estimates. So, again, that damage has been over the last 6 to 8 weeks for the most part. All right, let's talk Groundhog Challenge. For those of you that may not be familiar with it, we have run an annual stock picking contest at Manifest Investing for the last, is it 14 years? I guess it's 14 years. Contestants on Groundhog Day, February 2nd, pick anywhere from 5 to 20 stocks, and it's a horse race. You're not allowed to make any changes during the calendar year. And like I say, we've been doing it for 13 years, just been having a really good time. The thing about Cinco de Mayo is it's kind of really close to the quarter poll, so we're looking at the quarterly results. I love the picture. That's the Heisman groundhog to me. It'd be better if it was a bear instead of a wolf, but we'll work with that. As Ken was saying, you can actually get to this year's standings via the Manifest Investing dashboard, just clicking under the published dashboards on the middle of the right-hand side, as you can see there. I don't have all of them up to date, but I will have them audited and up to date within the next day or so. But here's a snapshot of what it looks like right now. Those of you that are not Manifest Investing subscribers, I believe you can get to it using that link up at the top. And most of those are stored as public dashboards, so you can drill into them. One of the reasons that I've kind of drugged my feet on this a little bit, other than being a little bit busy and a little bit too many margaritas in the afternoon or whatever, something's been going on. No, what has been happening, thanks to the bear market that we had, there was a point where if you looked at this a month ago, nobody was at the $1 million we started with, and I think the leader was at 950, and it was Hugh McManus. We're tired of Hugh being in the lead anyhow. So he was at 950, and everybody was a distant second, and it was just pure carnage from top to bottom. And I'm like, nobody needs to see this. Well, thank goodness the last month has improved the situation. You can see that 6 of the participants actually have positive balances above $1 million. And everybody on here is beating the market that's listed here on the leaderboard. And our ladies from St. Louis, they lead the all-time rankings. That's an investment club out of St. Louis known as the Broad Assets. The ringleader is Ruby Lawrence. So I'm raising my margarita in their general direction. They are far and above the leaders over the last 8 years that they've participated. Their average annualized return, total return, is 27.5%. And they're winning again. And you can actually drill into their portfolio. It's kind of fascinating to see some of the stocks that they've chosen over the years. We refer to some of their selections as Launchpad Investing. And they happen to have a runaway investment this year called Moderna. I think it's MNRA. Can you check me on that, Ken?
Mm-hmm.
I think it's mRNA. It's Moderna, and I think it's involved in the vaccination quest. And I think it's gone up several $100,000 for them and kind of propelled them into the lead. But Susan Michelik is right back in there again with the Bower City Ladies. out of Janesville, Wisconsin. Herb and his grandkids and his children, cool kids out of Traverse City, God's country. Hugh McManus, just to annoy us, is back towards the top. And Ken would like me to point out that he's on the leaderboard here tonight, along with his family club. So, again, those will be all updated here over the next day or so. I've got a few obscure companies to take care of that do weird things, but we'll get that taken care of. A lot of very familiar names. And again, we'll clink our glasses. I don't have anything to clink with. There, can you hear that? Clinking my glass, raising it in the direction of all the Groundhog participants.
I'd like to acknowledge the president of our newest model club, Mark. Her name is Charlene Hansen, and she's made the top 10 in the list. So more power to you, Charlene.
Oh, Charlene rocks. No doubt about it. All right. So let's go ahead and close out tonight with a few moments from Hill Street Blues. I'll bet a bunch of people in the audience remember these moments when Sergeant Esterhaus would be issuing the morning orders to all of his legions of first responders there, and he usually closed with "Let's be careful out there," and probably a good way to capture the moment that we're in right now. Why don't you go ahead, Ken, and what should we be careful about?
Well, I was a little, I don't know what the word is exactly, maybe taken aback when I opened up my newest magazine. It came to me 2 or 3 days ago, and I looked at the most active list and then the next 20 or 30 stocks on that most active list right there. I guess I was a little concerned by the fact that I was looking at lists that I found to be very, very aggressive. And I was asking myself the question, are these truly what the investment clubs of the modern era are doing with the cash they collect? Are they really buying as much Tesla as it shows up on the list right there? Are they really investing in Boeing at this particular time? You know, and I especially took a look at that second list right there. And while there's a lot of old favorite pals, great up, straight, and parallel companies that I really do feel had a bargain moment in March sometime when this data was probably being gathered. I also see companies on this list that are really companies with no earnings or very little earnings or no history or very little history. And I guess I want to bring clubs back to the reminder from our founder, George Nicholson, where he suggested that 70% or more of our portfolios should be invested in high quality growth stocks. And that's the old up, straight, and parallel model. Even when we have people speaking at our events that are picking stocks that don't match that particular model, they're making it clear to our audiences that still the vast majority of their portfolio is in fairly safe stocks that are going to end up giving us a return of 15%, 12%, 17% year over year over year in kind of a regular fashion, and that those are the stocks we want to invest in. Now, Nicholson did say there was a place for the speculative. There was a place for what he called non-traditional investing. But I guess I just want to warn the clubs out there that the place is maybe to occupy 15, 20, maybe 25% of your portfolio. It's not to occupy 50% of your portfolio with these types of stocks that don't have the kinds of things we're looking for to put together a good, solid portfolio that might last us for the next 5 or 8 or 10 years. Mark, what was your feeling about some of these stocks on this list?
That would be my reminder too. Mr. Nicholson also referred to those as general market securities, in some of the stuff that he wrote. And again, he's talking about more speculative investing when he's talking about general market. He's talking about general situations which are turnaround or very early stage investing. Amazon is kind of maturing now, but Amazon, 5 years ago was certainly an early stage company. Tesla remains an early stage company, and there's some really early stage companies on that extended list. And again, I'm not saying they're wrong. I tip my hat in the direction of whichever clubs invested in Zoom Video, because that is probably the top performing stock in the stock market right now, thanks to the sheltering at home. Just to show you how crazy this stuff gets, though, for those of you that are familiar with the automotive industry, were you aware that Ferrari's market cap has passed all of the domestic big three, including GM? I mean, that's just amazing. They make 10,000 Ferraris, total number of cars, a year. GM makes 7.7 million cars a year. And so, Ferrari having a higher market cap is just kind of a little bit of a warning sign. And Tesla has a higher market cap in terms of total value than all of the other car companies combined. I mean, that should be a staggering reality. And here's just a quick dashboard that's pointing out some of what Ken was talking about. And I have to say, I look at that most active list and I see a lot of mixed voting, buying and selling, including Apple having more sells than buys. And that does kind of correlate with this fairly well. These are with the stock market at 12 or 13% for the overall return forecast, MyPar. Basically, almost every company on this list is, a market average return. And look, you can see that Apple's actually the low, along with NVIDIA for that. I was a bit surprised to see Tesla where it's at here, Ken.
Well, you know what I feel about Tesla. I keep talking to you, and you mentioned Tesla, and all I say is, but it's an auto company.
But it's got a financial strength of 9% and earning stability of 11%, and that's being generous. And then,
right, and you can't argue with the people that have made a lot of money in Tesla, but I do feel that might be the outlier for a lot of that kind of investing rather than the rule.
And the other thing to keep in mind, Ken said that nasty word earlier, retest the lows. Companies like Tesla, and I'm just using that as a very broad brush, are the ones that tend to get massacred in a really nasty market moment. So you just have to be aware of that as you're going forward with your stuff. Here's another list that I like to pull down for a couple of different reasons. Here's one for some homework. With respect to Tesla, the fair value at Morningstar yesterday was 260 or 280. Okay, the company's at 767. They raised their fair value estimate from 260 to 710 in a day. So this is beginning to remind me, and again, this is. I'm not sure if it means anything. It's just, to me, it's the sergeant standing there saying, "Be careful out there." I remember 1999, and I remember when that was happening with companies like Qualcomm, and I remember watching companies that we were actually quite enamored with, and watching them go from $85 a share to $8 within a few days. So these are the type of conditions that you have to at least be aware of. And that's the biggest reason that Nicholson would have had for having this 75% core, 25% frisky part of your portfolio. There, I used the frisky word again. And then I'll just leave you with one thought. Facebook. We own Facebook. We've owned it since the IPO. My wife made me push the purchase button. So we're actually in on day one. She wants to be able to say that she's in on day one. Okay, so she's accomplished that. I think her cost basis is like $30 a share. Well, there's the chart for Facebook, and it's actually been pretty kind to us. But the point I want to make, and this is one that kicked around with Hugh McManus just the other day, because this one should send a chill. Think about Facebook, and could there be another Facebook or a very stiff competitor come along to basically try to unseat them? And it seems, oh yeah, it's going to be tough. That wouldn't be easy. It would be quite a hill to climb, but it's not impossible. And if you think it's impossible, I want you to close your eyes, think back 12 to 15 years ago to a company by the name of America Online. The ticker symbol was AOL. The operative phrase there was. They actually bought Time Warner. Think about that for a second. It was AOL Time Warner for a while, right? So these companies, much like the Titanic crossing the Atlantic Ocean, they're not invincible. They're not unsinkable. So in that context, you have to keep them in the right suitable apportionment for your portfolio. So again, if you think it's impossible for Facebook to disappear from the planet, rummage around in your closet and find that old Atari. These things happen. Any thoughts, Ken?
No, is that our last slide, Mark? I'm not remembering
we're getting
correctly.
close. Just some reminders about what the classes are. I did have one last thought here. I mentioned earlier about this thing. Ken and I did a presentation on the projected return on capital a few months ago. You can actually find it in the YouTube archives. The return on capital, right in the middle of the screen here. It actually does very SSG-like things, only it considers the debt equity also, and it also considers the cash. And the numbers generally are going to resemble par. They're generally going to resemble par, but the numbers that you see here are not that exciting for this group of companies. And that's something for you to scratch your head over and really think about. If I'm shopping for buying opportunities in today's market, I want numbers that are higher than that. So just give that some thought. There's the 5 classes that Ken talked about earlier.
I have a hand up. It's Herb Lemkel, one of the directors from Mid-Michigan. So, Herb, go ahead. You're unmuted.
Yeah, good evening. Nice conversation tonight. Mark, I just want to say thanks for doing the Ferrari, because if you haven't seen the movie Ford versus Ferrari, I would highly recommend it. It's a great movie.
Yep, it is.
Yeah. And then, but the other thing is that you missed Cherry Capital Investment Club in the Groundhog, and I sent you what I thought we had put to there. So
it'll be there.
Hopefully you can add us.
Oh, it'll be there. When I get them all in, we'll be just fine. I've got them all.
Thanks, Herb. Thanks, Herb. Appreciate that. Mark, I'm going to go to our question box now, and we've managed to keep it fairly short here. So let's try to get a few of these questions answered. But do you want
me to say good night first, and so we shut down the recording?
Why don't we say good night first and shut the recording down? That sounds like a good idea.
People would enjoy seeing my shoulder-length hair one more time. Well, good night, everybody. Thanks for being here. We will stick around and field some questions and answers, but we'll get the recording on its way. Thanks, everybody.